was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had. Well, the big move wasn't what I did today. The big move was what I did on Liberation Day.
President Trump there marveling at the bond market's bounce back after executing one of the biggest economic policy reversals in modern U.S. history. Live from Mumbai, this is Inside with me, Haslinda Amin, where we dive deeper into the story with crucial context and sharp analysis. President Trump's 90-day pause on higher tariffs from most countries sends markets soaring, with Wall Street staging its best rally since 2008. Goldman Sachs now seeing less chance of a U.S. recession. But Trump is hiking tariffs on China to 125%, pushing towards a decoupling of the two largest economies. And there seems to be confusion within the administration about talks with Beijing.
President Xi's a proud man. I know him very well, and they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
I am not engaging with them. Scott has not engaged with them. And the president, you know, he does expect to have conversations with President Xi, but that is between them. If we get a contact, we will just pass it to the president.
Chinese stocks gaining on hopes the government is set to load up the stimulus bazooka as the trade war and consumer deflation threaten the economy. And we get perspective on how to deal with a roller coaster market impact on your money. Citi's head of wealth, Sieg, will be joining us exclusively in just a few minutes. Well, that didn't last long. President Trump announcing a 90-day pause on higher tariffs to most nations just hours after dozens of U.S. trading partners were hit with the steepest American levies in a century. Trump's about-face on his signature trade policy came after he faced massive pressure from business leaders and investors to reverse course. But there's no such reprieve for China, with Trump raising duties to 125% after Beijing's latest retaliation. But he hinted that he is willing to make a deal with President Xi as well. Well, as for Commerce Secretary Howard Lutnick, he says the bitter trade standoff can only be resolved once Chinese President Xi Jinping agrees to talks.
I am not engaging with them. Scott has not engaged with them. And the president, you know, he does expect to have conversations with President Xi, but that is between them. If we get a contact, we will just pass it to the president. And this is really about him. He has said publicly that maybe they don't really know the best way to go through, but the answer really is it's a phone call between the two leaders of these giant countries.
U.S. treasuries and stocks whipsawed along with the headlines, and now Asian stocks are joining the relief rally. The region's benchmark jumping by the most in more than 2 years. Avril Hong is here with more. And Avril, be still my heart. Just a month ago, we were talking about how markets were just too calm, and now it's too volatile.
Yeah, but there are still some out there that think, you know, keep calm and carry on might still be the messaging. I mean, you talk about the stock benchmark in the region that's jumped by the most in 2 years. Just to throw out some more superlatives at you, the TAIEX climbed by the most on record. I think these export-reliant economies are really breathing a sigh of relief because the negotiations give them a bit of wiggle room. Though, given how dependent some of them are on China, I think you're still going to need to see a convincing thaw in U.S.-China relations to see if these stock gains can be sustained. Indeed, we haven't seen a let-up at all in the U.S.-China trade war. It's really tit for tat at the moment, and we're seeing how the onshore yuan earlier fell to the weakest level since the year 2007. We have also some economists calling this tariff reprieve one of the biggest economic policy reversals in modern presidential history. And indeed, we saw how Goldman, minutes after issuing a U.S. recession call, was forced to reverse it. And Trump might be calling the bond market a thing of beauty, but I think for bond traders, it's really a joy for never. It was a day of pure mayhem. We're seeing U.S. Treasuries. If we can just take a look at how they are faring at the moment, I think they are rising across the curve. Sharp spike earlier, though, in the 2-year yield, 30-year. We saw the yield wiped out and increased. It's just a matter of a shift of which tenor has been absorbing the selling pressure. It's been described, Haas, as a no-win market for Treasuries.
Well, still trepidation in the markets. Everybody's kind of confused of what they should be doing now. Avril, stick around, because joining us for his market insights is Andy Sieg, head of wealth at Citi, who was advising clients earlier in the week not to buy the dip. Andy, good to have you with us. If you had bought the dip, you would have made money. What are you advising clients to do now?
Well, we've been pretty consistent for several weeks. This is not a time to add to risk assets, and no surprise. This is a pivotal moment in terms of changes in global trade. When you take a step back, regardless of what's happening here day to day, week to week, what we know for sure, this is a tectonic shift in policy. Even on the other side of lowering or increasing the timeline to reciprocal tariffs, there's certainty here. U.S. tariff rates are going up meaningfully to 10% minimum levels. So this is in dialogue with all of our clients, changing their perspective on markets, and as importantly, changing many of the discussions in boardrooms about how they run their businesses.
So what are your clients saying, and how is this all impacting them? Are you seeing margin calls, for instance?
Well, this is, we've certainly, in alignment with other banks, we've seen margin calls. They've been well managed. These are margin calls that, have not been a surprise to us. Market activity has been, despite the volatility, relatively orderly. Markets have been well functioning. We feel very good with the advice we've been delivering here in terms of caution, because in the intro you talked about how difficult it is for any of us to pin down macroeconomic implications of these policies. And when you bring that down more to the corporate level, there hasn't been time for the sell side to update estimates in terms of earnings for most corporates. And you've seen, very limited adjustments in terms of guidance coming from companies. We saw guidance pulled by a few U.S. corporations yesterday. Investors aren't going to get clarity until we get into earnings season tomorrow and over the next several weeks. And I think, for investors, it's hard to know whether this market at any given point right now is cheap or expensive. We're watching prices move, but we don't really know in a PE ratio what's happening to the E.
So it is difficult to tell. I mean, there's so much uncertainty still. But in terms of asset and asset classes, is there one where you've changed your views on, given the last, developments in the last 2 weeks?
Well, I mean, we have even more focus on some non-correlated assets, as you might expect. With our clients, we're once again, with volatility like this in the markets, their interest is in hedge funds, and so we're seeing increased investor focus on hedge funds. We're also, of course, seeing clients who may have a directional view on markets also want to build some protection. So structured notes right now are central to a lot of client dialogue that we're having. Again, we really want to keep our powder dry at this point in markets. Our Chief Investment Officer, Kate Moore, a very well-known investor, reminds us frequently, sometimes as hard as it is, you're best positioned as an investor to, not do a lot in the moment, not overreact to headlines, particularly at a time where it's difficult to have conviction when you really don't know what's occurring with fundamentals.
Indeed, to your point about, kind of reassessing things as they go along, we're seeing U.S. futures declining, so reversing what we saw overnight. What is your sense of what we've seen in the past couple of days? Is it a sort of clearing event, or is this a new normal?
Well, it's hard to call anything in the last few days normal. What we're seeing is, in many ways, for those of us who have been through cycles, we're seeing, kind of a classic shock factor that markets have when news like this comes on the scene at a magnitude we had never experienced. I think what we know for sure, we've passed peak shock. The world now knows this tectonic shift is happening. What we can't know yet is the way this is going to flow through to economic activity, corporate earnings. We saw some parts of our investor base react very quickly across Citi. Obviously, hedge funds were moving even before last week's announcement. Real money investors moving a little more slowly. I wouldn't say that we've seen wholesale selling of equities in U.S. retail yet. That takes a while to unfold, particularly given retirement plans in the U.S. and other more stable pockets of U.S. equity investment. So this is, we're in a different phase. And, I would say to investors who are thinking about, entering these markets, do so with caution and discipline, have a core asset allocation that's set. And to the extent you do want to, try to be in and out of this market, have it be very thoughtful, a limited amount of your portfolio and, with the appropriate order management, hedges so that, this market doesn't run away from you, because we're seeing, again, swings that are 9 sigma events yesterday in the U.S. market.
So that's for U.S. stocks. But what about for U.S. treasuries? They're supposed to be the safest, right, in the world. Yet those ructions that we saw just a day ago, does this all complicate where investors kind of hide, take shelter from the storm?
Well, I mean, overall, U.S. Treasury market, certainly there were some moves that were fairly dramatic for the Treasury market yesterday. Treasury market overall, though, is very well functioning. And I think that, I think investors around the world can continue to have confidence in the U.S. Treasury market. In fact, we're talking to clients right now who are hearing our message about caution in equities. Short-term treasuries is the place for them to be, in our view, with assets while they're waiting to move into markets. And so I think for our investors, I wouldn't overread changes in terms of U.S. Treasury market. We feel a great deal of confidence there.
But Andy, some are already talking about alternatives to U.S. Treasuries and that international investors are, in fact, pulling money out of U.S. Treasuries.
Well, these are, the vast size of the U.S. Treasury market. At the margin, we see investors, looking at other corners of the bond market, certainly. But the U.S. Treasury market is so central to, the way the global financial system works. These really are fairly marginal changes, on the increment.
So what does it mean for your 60-40 portfolio? Do you stay the course? Would that 60-40 portfolio still protect you from a potential recession?
Yeah, we think it will. Today the 60-40 portfolio is not as straightforward as it was 20 years ago. We've got, given the size and scale of private markets, for most of our clients, we recommend an exposure to alternative investments and to be active in private markets. For our private bank clients, that can be as high as 25 to 30% of their portfolio. That long-term advice, we think, is grounded in very strong analytics, and that's advice we're sticking to. What we worry about is not that. What we worry about is in times of fast markets that without the right advice and without the right partner, investors fall susceptible to what all humans fall susceptible to, which is emotions overtaking reason in times of stress. And so that's when our bankers and advisors add their most value. And frequently, as it's been in the last few days, it's advising clients, hey, don't chase this, don't buy the dip. Let's try to be disciplined at a time that the world's moving very fast.
Yet at the same time, Andy, I get your point about everything's still well functioning, don't chase the dip. But these headlines have certainly destroyed some confidence in the U.S. as a trading partner, potentially as well the U.S. as a place to kind of park capital. What are you seeing in terms of your clients' and their concerns, longer-term damage being inflicted on the U.S.?
If you take a step back, Citi's been around for 200 years. We've seen a lot of cycles across this business. What I think we hear from our clients is they're looking for a financial institution that has the perspective that comes from that scope of history at Citi. When you take that lens to today's moment, what you feel is certainly there are changes that are happening. Clients are looking for a clear-eyed analysis, however, not hour-to-hour interpretation of policy, and certainly not our view of policy. Therefore, what we see is rising volatility, uncertainty. We're trying to, again, point to fundamentals to kind of guide us with markets, and we're trying to do what is frequently difficult, which is say this may be the moment to not really do much of anything and to stay put. We think there will be better points to enter on the other side of earnings, where we'll have a background of more economic data and more earnings data to have real conviction.
So, Andy, just to be clear, Citi clients are not really looking to move their money from the U.S. to other parts of the world?
No, they're not right now. We certainly hear our clients in their businesses trying to think about operationally where they have people in operations. But as you know, these are conversations which are very active right now. But these are multi-year decisions.
Andy, we just have breaking news right now. We have China leaders to meet on stimulus after Trump's tariff shock. Of course, we've been expecting China to come up with a string of stimulus, bazooka stimulus, in fact. And now we're getting confirmation that China leaders will be meeting on stimulus after Trump's tariff shock. By that, we mean, of course, Trump raising that tariff to 120%. Andy, just your initial thoughts on China's reaction. And it's not surprising that it wants to implement more stimulus to prop up its economy. How are you viewing the potential of the China's market?
Well, I was in 5 cities in China last week. You've seen PBOC move in the fall. President Xi engaging with the business community quite actively, DeepSeek. I mean, there's been a series of steps, in and around the Chinese economy, which have been, adding real momentum and demonstrating support for Chinese government for the business sector. What you've just shared with me is a next step there. I think it's a next step in a direction of travel, though, that's been set for quite some time. I came away from some of the meetings last week seeing real vibrancy and real progress in the businesses that many Chinese corporates are leading and driving. And again, this is one more reason why we're going to watch the tape, and we're going to be seeing news on the tape on an hourly basis right now, which is extremely difficult to invest behind. Therefore, in fast markets, in times of volatility, a calm, clear-eyed approach is what carries clients forward.
And of course, rising murmurs of a potential decoupling of the two biggest economies. How is a company like Citi navigating all of that? How are you assessing the risks?
Well, this is a time when the global perspective, the global reach of Citi matters most to our clients. What we try is, across our network to help clients get their arms around, not just developments in Washington and developments that are taking place in Beijing, but how other corporations that we're serving are adjusting to meet the moment. Again, when you think about a time like this, the resources in the inside of the world's most global bank is more valuable than perhaps at any other time. And, incidentally, I should mention, we see global trade continuing, of course, despite changes in policies around the world. We see companies continuing to operate global supply chains and deliver into global markets. And we see individual clients who continue to have global dreams, living and moving around the world. That won't change in our view. And, we're in position to try to deliver the advice to make a difference.
But what is expected to change, Andy, is growth. We have the OECD coming out to say that growth will be impacted, it will be slower. And when it comes to growth in creation of wealth, where do you see that, especially in Asia?
Well, I mean, wealth creation in Asia is, it has been leading the world in terms of rate of growth. We think that continues. We continue to have a view that we're going to see wealth creation taking place at historic levels over the next 10 years. Estimates that we anchor to see $100 trillion of new wealth creation over the 10 years out ahead, and the fastest rate of growth being across Asia. That's why, I'm here, and I was in China and Hong Kong last week and earlier this week, because Singapore and Hong Kong are the hubs for the most dynamic part of Citi's global wealth business. It's where we're adding people and resources and where we see clients coming from around the world. So here in Singapore today, the conversations are around southbound flows from China, clients from India who have moved family offices here, increasingly clients in the Middle East who, again, view Singapore as an appropriate booking center for many of their activities. So we think that the wealth business in Asia is going to be the most dynamic area of wealth business around the world.
Andy, I think you mentioned previously a 10% increase in Asia headcount. Is that going to bring the total headcount for the region to the level before prior retrenchments? What
you'll see in terms of, and specifically I was talking about double-digit increases in terms of our advisors and bankers in front of clients. You're going to see those levels. I mean, they're surpassing where we were several years ago, certainly. What we've been through at Citi under Jane Fraser's leadership is a powerful and very positive restructuring and refocusing of Citi. In the aggregate, our employment levels across the company globally have been fairly constant, but what we're trying to do is move some of our resources from middle and back office roles to have in wealth even more of our professionals in front of clients. And so you'll see advisor and banker headcount rising, and you'll try to see us be very disciplined around some of the cost and the scale of teams supporting those activities on the front line. That's where investments in area like artificial intelligence make a real difference in terms of the way we can operate our business.
I was just going to ask, how exactly is Citi using AI in the wealth business?
Well, I mean, step by step, like most companies, we're finding initial ways that we can do day-to-day tasks more efficiently. We have exciting work underway that's not yet in pilot to be able to deliver advice to clients in using AI. Have some of our research messages, for example, much more customized to the clientele and the portfolio that they own. You'll be seeing developments like these over the quarters ahead. They aren't far out, but we're also we're trying to be very responsible here in terms of introducing AI that would be actually customer facing.
Andy, as we look at the headlines that China leaders are meeting on that stimulus, is this enough for you to be dipping your toes into the China market? How are you looking to invest in this particular market?
Well, we have seen in the cycle in the last 5 or 6 years, we see a lot of excitement around fundamentally what's taking place in the Chinese corporate sector, a recognition here that whether it's AI that we were just talking about, advanced manufacturing, some real leaps in the EV industry. These have been exciting developments. There has been, though, from investors outside the region, some understandable caution in terms of devoting capital. We have a balanced, we have a global set of portfolio recommendations in terms of geographic balances of portfolios. Our investment committee, like most, will be meeting over the weeks ahead to try to make sense of the whole collection of changes which have occurred in the last few weeks. I don't want to front run that, but China equities and the China story is part of a global portfolio we talk to clients about, and again, our Chief Investment Office will be reevaluating that over the coming weeks.
Andy, when you talk about China, you have to talk about India, where I am. We know that you made an exit from retail banking as well as the wealth business. Any plans to come back in?
Well, You know, the restructuring of Citi, which we talked about a minute ago, what Jane has done is made us a much more focused and fit company around the world. So, you know, we did exit some areas of the market in India, but in aggregate, you know, Citi's business in India is far larger today than it was a few years ago. Our corporate business is thriving. Our services business is thriving. We're an advisor to, you know, leading companies across India. So the Citi India franchise is very strong, and that's a microcosm of Citi's story. We have other markets in Asia where visibly we exited the retail bank, but our wealth business is growing offshore from the Hong Kong and Singapore hubs at a pace and at a scale that's in many cases already surmounted the size of the businesses that we exited. So Citi's on the move. This is a franchise which is growing across Asia, and I think it's growing with more discipline and therefore an ability to better serve our client targets and better deliver for our shareholders.
Andy, before we let you go, what keeps you up at night? What's the biggest thing, biggest issue on your mind?
Well, what's keeping me up at night lately is the news flow has meant, you know, the longest sleep that any of us have had is 3 or 4 hours. You know, I think what we want to see, we know the power of a deeply intertwined global trading system and global market system. We also know the U.S. administration and President Trump are very focused on manufacturing jobs in the U.S.
Right.
And, you know, reconciling these in a way that we can all navigate, that's what keeps me up at night. That's what we want to deliver to clients.
Andy Sieg, Head of Wealth at Citi. Thank you so much for your time. Do come back. Still to come, Societe Generale's Greater China economist will be joining us for that. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Chinese stocks are climbing after Trump's tariff reversal. That's despite the U.S. president ratcheting China levies up to 125%. April, well, the market's just shrugging off the shoulders, 125 bucks. China keeps going up.
Yeah, I think it's really how this element of stimulus has perhaps already been priced into markets. 125% in terms of levies that really fuel speculation. We could see an acceleration of stimulus. So perhaps that illustrates why today the Hang Seng, don't forget, climb on Hang Seng Tech more than 6% at one point. Pairing gains now, maybe a bit of sell the fat going on. But don't forget as well that even as we watch out for stimulus, we have China data today that just confirm the country is still seeing steep deflationary pressure. Now, keep an eye on the renminbi as well. Onshore, of course, yesterday or earlier today, I should say, we did see it falling to the lowest level against the greenback since the year 2007. It's a bit firm now at the 734 level. Let's flip the board and take a look as well at some of the other stocks that are in focus in the Asia Pacific today, including the ones with Vietnam exposure. Given these tariff headlines, a bit of reprieve for them. We saw the likes of Hang Seng climbing by 10%. Even some of these Nike suppliers also doing well. All eyes here are really what's going to be next on the tariff front and on China stimulus, Haas.
That's right. China stimulus in focus. Of course, we had that scoop from Bloomberg talking about how Chinese leaders are meeting to discuss the stimulus on the back of Trump's tariff shock. Here we're talking about 125% tariffs, those set to focus on measures for housing, consumer spending, as well as technology. Let's get insights, perspective from Michelle Lam, Greater China economist at Societe Generale. Michelle, your take on it. We've heard time and time again that China has the toolkit. What's in that toolkit?
Well, there are many things in the toolkits, and well, desperate times call for desperate measures. So I think the most essential thing the policymakers should focus on is really to boost consumption. And this is something that they have been working on. For example, this year at the March MPC, they already doubled down the amount of consumption subsidies provided to support the trade-in program. And I think it's quite likely that we could see more measures coming from this trade-in program, say, expanding the amount or even broadening the program to cover more goods and even services. And a lot of things that they've discussed before, such as the childcare subsidies, I think these things can be accelerated. We have already seen some local governments already starting to announce plans to give out some subsidies to people who have kids. And I think these things can be rolled out in a national basis to support consumption. But I think the other thing that's also important, I think apart from the usual infrastructure stimulus to support domestic demand, is housing. Because we've been saying that housing is really a big roadblock to consumer confidence. And right now, even though we are seeing some green shoots in the first-tier cities, if you look at the prices in the low-tier cities, they are still declining. So I think if it is possible that the policymakers could accelerate some of the measures, such as the housing destocking program, maybe or even cash settlement to support the urban villagers to buy new houses to support the destocking. I think this could be more helpful to stabilize the housing, and that's very important for confidence.
But suffice to say, Michelle, what's needed right now is stimulus bazooka. The time is now, given how those tariffs will impact China's weak economy even further.
Yes, well, actually, in recent days, we've been receiving clients' questions of what is the amount that the policymakers could roll out. Is there a limit? And I think actually there's no limit, because we are talking about enormous trade shock to China. Well, U.S. exports to China is worth 3% of GDP, and the tariff levels you are seeing right now essentially means that these 3% of GDP could almost be wiped out, and that's just focusing on the direct impact. If you look at also the indirect impact, the uncertainty impact, weighing down on investments and job losses leading to declining consumption, this could be more. So I think the policymakers have a lot of policy room to deliver the bazooka. The thing is, though, right now we are still seeing a lot of uncertainty, as in there could be still hope for negotiations between the U.S. and China. So as a start, I think policymakers may not announce a big number at the beginning, but I think the key point here is there is a policy put from Chinese policymakers.
We know that the PBOC has been keeping its powder dry. What do you think it will do this year? Or at least in the next few weeks or even months?
Yeah, of course, FX stability has been a concern for the PBOC, as we've seen over the past couple of months. And even though we are seeing the CNY being adjusted down a little bit recently, I think FX stability still matters to the policymakers. So that could still play to some extent as a constraint to the scope of interest rate cuts. But considering that if the Fed is going to cut interest rates quite aggressively, as markets are pricing in right now, I think there's scope for the PBOC to cut policy rates further. But I think the key point here is that the fiscal policy will be playing a more important role. And the things like the balance sheet expansion by the PBOC, I think the things that they have been doing last year, I think there's actually scope for them to expand that even more. I think in the short term, we are going to see more special CGB issuance coming from the government to support the fiscal stimulus. And I think this coordinated measures between the MOF and the PBOC will essentially mean that they have unlimited scope to support the economy.
And we've seen a willingness on the part of the PBOC to see a weaker currency, the yuan trading at the weakest level since 2007, I think. Is it reflective of the weak economy right now, bearing in mind that those tariffs may wipe out 3% of GDP?
Well, to some extent, but I think, well, we are talking about 125% tariff. So there's no big currency depreciation that could really offset the impact. So I think it's just not realistic for us to expect the FX to play a role in mitigating this tariff shock. I think it could be to just allow slightly more flexibility to try to get the FX flows cleared with a slightly weaker currency. But I think at the end of the day, I think the FX stability still matters a lot for the people's confidence in China, for the confidence of the investors in China's assets. So I think there is very limited benefit for the government to pursue a big one-off depreciation.
Right. So is there a line in the sand for the PBOC to ensure that perhaps 2015 doesn't happen again, that people don't start selling all Chinese assets?
I think people are watching the fixing very closely every day right now, but our expectation is that we will not see a big FX depreciation like what we see in 2015 at least. And if you look at the last US-China trade war, China allowed the CNY to depreciate against the US dollars by around 10% back then. If that repeat today, we could get to like a pretty big number. And I think even for that, maybe it could be just the worst case scenario on what we can see on the FX depreciation.
Talk to us about the risks of capital outflow. How are you assessing that?
I think the experience over the last couple of years have proved that the policymakers have a very strong capability to prevent capital outflows, to tighten controls in China, to prevent that from putting a lot of pressure on the FX. So there are still measures on things like they can increase the foreign RRR to try to slow the amount of capital outflows. And I think in recent days, they've also told the state-owned banks to reduce dollar buying. So I think on that front, I'm not so concerned about the capital outflows, as policymakers have pretty tight grip over that.
I know you're an economist, but if you were to just glance at the markets, has it been quite surprising that the Chinese assets, Chinese stocks have been resilient compared to the rest? And they have done better compared to their counterparts in the U.S.
So the national team is clearly playing a big role here in supporting the stock market. And I think as of today's rebound, you see some of the names that you mentioned also rally. I think it's also because if you listen to Trump's message overnight, it seems that there's still a door for negotiations from both sides, although it's not clear who will back down first. My guess is that it's unlikely for Chinese leaders to back down first because of a matter of pride. But in any case, I think even though maybe there's still chance that for this 125% of tariff to be negotiated down, I think the objective of the U.S. policymakers is pretty clear, which is I think that decoupling from China is the number one objective rather than trying to rebalance it and cut trade deficits with a lot of countries. So in that case, I think even though there would be big collapse for China's exports to the U.S., maybe Chinese companies still have a role to play in the global supply chain. We've seen a lot of Chinese companies playing a role, like exporting some intermediate good products to some of the Asian countries, and that essentially ship back to the U.S. Eventually. So if Donald Trump thinks that, the tariffs on other countries can be lowered to 10%, things can be negotiated. So there's still hope that China can still play a role in the global supply chain.
But isn't it true, Michelle, that the deflationary story in China will persist? We're already seeing deflation for a second month in a row.
Yes. Actually, regarding today's data, I would say that looking at the details, CPI was minus 0.1%, but actually food inflation played a big role, the food prices. You look at core CPI, the picture is not as bad. But to be sure, yes, going forward, I think the deflationary momentum will be pretty entrenched. There will be a lot of excess supply of goods previously shipped to the U.S. Now they will have to be digested in the domestic market or in the foreign market. So that's going to bring downward pressure on the producer prices quite notably in the short term. But at the same time, we are also looking at Chinese policymakers providing more stimulus to offset. And I think all these things just accelerate their agenda to rebalance the economy from investments, from trade to consumption. So I think taking a longer term perspective, yes, there will be U.S.-China trade decoupling, but you can look at this as a one-off one-off shock that, yes, afterwards, exports to the US will decline, but maybe a few years later, the incremental shock for the economy will not be as apparent as now, and it just leaves policymakers even stronger focus on consumption, which we think is very important, not just for China, but also for the global rebalancing between US and China.
Michelle, before we let you go, are you concerned that China is now looking increasingly isolated? It does seem like the U.S. is trying to do just that, isolate China, get its allies together to work against it.
To some extent, yes, but I would say that for some countries like in Asia, it's also not easy for them to pick sides. And afterwards, I think at the end of the day, it's the question of what China can offer to these countries. China is now focusing on strengthening domestic demand. So maybe 10 years down the road, it can play a bigger role in terms of absorbing these exports from these Asian countries when it manages to rebalance with stronger imports. They can also offer a lot of investments to the countries. Like this is actually how China manages the One Belt, One Road relationships. So I think at the end of the day, it is still a matter of the costs and benefits for the countries to pick sides, and it's actually not a clear-cut question for them.
Michelle, great insights. Michelle Lam, Greater China economist at Societe Generale. And you can also turn to your Bloomberg for more of our tariff coverage as the 125% levy on China comes into force in just a few minutes, just after noon in Beijing, by the way. Hong Kong and Singapore. Go to TLive Go to get commentary analysis from Bloomberg's expert editors. Now, coming up, India's central bank switches to an easing stance, signaling more rate cuts to come after yesterday's 25 basis point move. We discuss the outlook next with QuantEco Research. Keep it here with us. This is Bloomberg. Welcome back. The RBI cut interest rates yesterday and signaled more easing to come in the face of U.S. tariffs, lowering the key rate 25 basis points to 6%. The Central Bank's Monetary Policy Committee also shifting its stance to accommodative from neutral. Governor Sanjay Malhotra trimming forecasts for inflation and growth as well.
The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year.
Well, joining us now is Shubhada, founder at QuantEco Research. Good to have you with us. It's a public holiday, but you made time for us. Appreciate that. It does seem like when it comes to this governor, growth is key. That is his priority.
I would think so, because he came at a time where inflation had begun to show some signs of easing, with just one kind of a nasty surprise that we had. But having said, growth was looking slightly more of an area where support was likely to be expected from the central bank. And true enough, in February, he started with a rate cut. There was an easing of cash reserve ratio, and we've followed it up with a second rate cut. And particularly, it gets validated given the external environment. Closer home, the domestic inflation trajectory, importantly, looks benign. Going forward into this current fiscal year, 3 of the 4 quarters, the RBI has forecast inflation below 4%. That gives confidence and growth, particularly. If inflation is benign, the focus of the central bank could then get to growth supportive measures. And that's exactly what he's he's doing, in addition to the monetary steps that he took, he also began to take some steps on the regulatory easing on credit front, particularly restoring the credit risk weights, which had been raised on the unsecured personal loans a few months ago. He eased those as well. So altogether, I think growth support becomes the focus for the central bank now.
I think what was really appreciated was the clarity in his messaging. He talked about how they've moved to the accommodative stance, meaning it's either status quo or more rate cuts from here.
Oh, yes, absolutely. I think that was fabulous to see a central bank governor.
Unusual.
Mincing no words. Hitting the headlines with what I mean by accommodative and what do I mean by not linking it with the liquidity steps that I would take. He was very clear about that as well. He said accommodative implies a status quo or a cut, which obviously most of the market participants had veered towards, forecasting those numbers. Importantly, he also said that let's not link liquidity to the rate cuts. Essentially, liquidity would be an unfolding kind of scenario. Wherever the system needs liquidity, RBI will ensure that there is not just adequate but ample liquidity, which has been the case since December onwards. RBI has actually pulled all plugs and injected a huge amount of liquidity, close to 6 trillion, going forward right into the first quarter. And liquidity becomes important because transmission that gets enabled more efficiently. And up to June quarter, we could see another 4 to 5 trillion rupees. Of course, a large part of it will come through the RBI surplus, where the results get announced end of May, and about 2.5 trillion would be getting injected into the system.
The focus, of course, is on the impact of tariffs. Yes, India will be negotiating with the U.S., but still, that 24% tariffs might still be in effect. I'm just wondering, what would that mean in terms of growth, and how deep should rate cuts be to ensure India gets to the growth it wants to?
Oh, I think that's a great question, because how can we not talk of tariffs in this roller coaster environment? India, of course, gets lesser than what the other Asian peers are attracting in terms of tariff rate at 26%. Vietnam, China, of course, is at ever increasing rate at this point in time. But having said, I think for India, the vulnerability to trade has been relatively lower compared to its Asian peers, if I may add. If I were to look at trade intensity of India, it would be less than or around 30%. And in particular, if I look at exposure to the US, it would be, in terms of imports, it would be around 6 to 7%, and exports would be around 17%. So altogether, the vulnerability of India's trade kind of exposure remains lower.
It is an interdependent world.
It is.
And with a country like China being a trading partner, it can't be buffeted fully.
No two ways about it. So directly, maybe the impact immediately may not be felt, more on the sentiment that, oh, India has attracted lower number of tariff structures. But having said, I think, as you rightly put it, we have supply chains, we have capital flows, we have financial markets, and of course the sentiment. All these 4 channels will be very critical in watching what the ultimate impact, second-order impact on India would be, particularly when we look at supply chains or foreign direct investment. In recent months, on a net basis, India has seen foreign direct investments trending lower. Of course, it's a worldwide phenomenon, given the kind of uncertainty. The investment scenario looks pretty much tentative globally, but for India, it has been more pronounced in the last 1 year or so. So trade definitely will have its disruptions on Indian economy, and to that extent, the vulnerability for growth, for the reason where RBI has marked down its growth by 20 basis points. We ourselves at QuantEco had lowered our growth estimate is closer to RBI's at 6.4, and inflation, of course, at 4.1. So pretty much in line with what RBI is saying. But growth will be seeing more of a downside risk than an upside risk, given the kind of uncertainties that prevail today.
Do you think investors are underestimating the downside risks?
I would think it's too early to say. Assessments have been more in the nowcasting than forecasting at this point in time, given the everyday change world over of what's happening to tariffs. Having said India's focus on, stitching deals with many of the world trading partners, be it Middle East or Eurozone or Australia or UK and EU, I think these trade deals would stand in good stead for India going forward. Obviously, it is a long-term phenomenon. It's not likely to play out in the immediate horizon. So for this year, we do look at growth getting paired because of all the trade friction. Let's not forget that trade, the years it contracts, it also leads to perhaps lowering of growth. In last half a century history, trade has contracted almost 13 times, of which twice it has resulted in world recession. And 11 times, if I remember, has resulted in lowering of growth by 110 basis points. So the vulnerability obviously lies on the downside risks for India as well in an integrated world.
Right.
But domestic drivers, fortunately, are turning around in the positive direction, be it on consumption, rural, urban, and so on.
Shubhada, thank you so much for your time today. Great insight. Shubhada Rao,
Pleasure. Founder
at QuantEco Research. Now, before we go, here's a look at our exclusive guests for tomorrow. GeoStar Vice Chairman Uday Shankar will be joining us here in Mumbai to discuss their efforts to reach 1 billion viewers across digital and TV platforms. Plus, JP Morgan Payments Global Co-Head talks to us about ramping up hiring across Asia. So you don't want to miss tomorrow's insights. We're counting down, of course, to China being hit with that record 125% tariff by the U.S. You can catch more on that on T-Live Go, on your Bloomberg, and also on Horizons Middle East and Africa coming up next. That is it from Insights. Keep it here with us. This is Bloomberg.